Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson and back with Cash Converters. And for those of you that want to know who Cash Converters are, go back and watch the interview I did with Sam Budiselik back in August last year. You'll understand the whole business. Today, we're going to be talking about their half-year financial results, what's happening, the growth of the company, and what's on plans for 2022. The ASX code is CCV, market cap about 160 mil, and a good strong share price. So lots to talk about today. Sam, great to see you. Thanks for joining me on Small Caps again.
Thanks for having me, Kerry. Nice to see you again.
Well, given that COVID's been around and Cash Converters have got stores, bit of an impact. However, you've had some strong growth. Talk me through some of the financial results, these half-year financial results, and what's driving that, do you think, at the moment?
Yeah, thanks, Kerry. Look, I think we've all been talking about COVID for a long time. So to hear this was the half that was the most heavily impacted by lockdowns is, a bit of a surprise. Maybe we're seeing a lot of the retailers talking to the impact of that first quarter of the financial year, or the first half of the half. So we lost our store trading days. Over about 24% of possible days were lost due to lockdowns, particularly in New South Wales and Victoria. And that obviously has an impact on our store business. But I think really pleasingly, we're looking at the underlying result for the business. We've had a really strong trading period, even taking that into account. So, we've seen good online growth. We've seen our stores reopening. We're coming out of that lockdown period, hopefully, and if anything, we think that will ease now. So we've, since we last spoke, been through a lot, but are in a really strong position and have traded really well considering that.
Yeah, and I think that's really important. You just mentioned 24% of stores being impacted during that COVID lockdown, the trading period, but you've still had growth. Has it shifted at all? Has that sort of online growth surprised you?
Yeah, I don't think so. I think it's a continuation of the trend that we saw through the initial sort of lockdown phase. And if anything, we've seen our online business maybe grow another 10% to contribute about 65% of our outgoings now in our lending business. So it remains elevated and it remains strong. We're really of the view that as the stores open and people are allowed out again and people can move freely, that we'll see the store contribution start to balance back a bit again. But we're well positioned online and those strong growth rates are terrific. So, no matter what happens, we're there and we're able to reach our customers. I think that was really important through the half.
Let's talk about the numbers if we could, Sam, because from an investor's point of view, let's talk about revenue and the operating NPAT, if you would. Let's go through some of those numbers so people can understand where the growth is coming from and the strength of the business.
Yeah, Kerry, you sort of touched on a non-cash impairment that we've made in relation to certain stores due to these COVID triggers. So we'll put that aside for a minute and talk about the underlying business, and that's sort of talking through the actual momentum in the business and the result that we posted. We call that an operating result in our business. And so looking at that, I think what's happened is our loan books have continued to grow really strongly. And we spoke last time about moving away from the shorter term lending to build that longer term, lower cost loan book and profile. And we've grown that book about 111% across the half period, the December to December period. So the book doubled when you look back to that endpoint of the last half. And that's really reflective of that focus in this business, moving away to offering our customers, innovative, lower cost, longer term options that I think better suit the needs. It lowers the repayment profile. The weekly repayments are lower and the consumers are better placed, I think, as a result of us doing that. So that book, that part of our loan book grew really strongly. And our overall loan book grew about 23% in total. So our vehicle book and our other loan books have also grown strongly. So, considering the challenges that people were facing, if you cast your mind back to, 1 July, it's quite an impressive result as consumer spending's been dampened and mobility's been restricted. We've still posted really strong growth rates in our loan books.
I'm curious, Sam, because there are other lenders out there. There are other opportunities. You've got the banks and you've got other lenders out there and, you see them on the news and, sorry, not news, on the ads on that terrible thing called the Idiot Box. I mean, how did you attract and grow that loan book in such a strong way? Because that's an impressive growth percentage.
Yeah, I kind of look at the longer term lower cost loans as a vertical with a number of competitors operating, and I think we've got 90-odd% brand recognition. A lot of people know about cash converters, and a lot of people trust cash converters. And I think when people are out looking for a partner to meet a cash need, there is an element of trust and responsibility that goes with our brand. And the more people we can win into our business, the more we can demonstrate that we treat people with respect and we meet responsible lending obligations, and we take that very seriously. So I think it's a product of, we've released some new product to introduce new people into our business. We've had a good general level of brand awareness out in the market. We've released a new consumer app so you can log on and see your loan balances and take loans out. So the digital engagement's improved a lot. Yeah. And we're seeing a younger customer cohort moving into the business as a result. So to answer your question, I think we're competing well.
Sam, is technology playing a part in your growth as well? Because the younger generation that potentially do need these loans, they love a good app.
Yeah, absolutely, Kerry. Our latest product release was digital only for that reason. And I think you've seen a real shift in the younger borrower looking for an easy, simple to understand product served up online. And we've really invested in that channel, and that's yielding results for us, like I say. So it's been really a positive move through COVID, accelerating that development and pushing us down that path a bit quicker than we might have otherwise.
We're coming into March, as I taught you, March 22. What do you see as the growth for cash converters this year? How do you keep building? Because I want to go into some of, the shareholders' dividend, that sort of thing. This is really, I'm impressed. We love a dividend. We'll talk to that in a minute. But talk to me about the growth strategy for 22.
Yeah, I think if you think about the loan book growing well in November and December, and that's really carrying through early parts of the second half as people have gotten out and started spending. One of the sort of functions of the loan book is that the upfront loan incurs an expense charge of a provision. And so in that first half, we've really built a big provision up off the back of that lending that then flows through into our second half in terms of the revenue and the income that comes through. As the stores have opened, it takes a little while for the water to flow through the hose and to get the stores operating again. They're part of our supply chain. We're procuring our inventory from people to sell, and people are pawning items. And with those stores open in that second part of the half, they're coming back as well. So good loan book growth, good store trading activity coming back. The vehicle market, which is another unique market, is starting to normalise as supplies coming through and secondhand car prices are settling a little, and our vehicle volumes are going up. So they're all great organic sort of growth outcomes. And then on top of that, we're in a really strong position financially where we're assessing certain acquisition opportunities, whether they be loan books or business opportunities, to grow inorganically as well. So I feel we're in a really strong position to sort of couple those two elements together. And hopefully we've weathered the worst of the past. We get to a more normal trading environment, and we see the business refloat more widely, really.
Talk about a very strong balance sheet and the opportunity for acquisitions. Do you see yourself, Sam? Because one of the things I do like about the way you lead this company is you talk about responsible lending, and you also talk about, I guess, respect for the customer, because it can be a bit of a murky industry, if you like. Do you see cash converters almost looking to clean the industry up a little bit?
Yeah, we really do want to lead that, Kerry, and I think our actions speak louder than some statements I hear made in the market. And we've spent a lot of time really building the technology under the hood to enable us to responsibly arrive at a position for a customer. We've then taken that technology more into the customer-facing side. But first of all, we built the engine properly to make sure we got that right. And then I think with our product development and really moving this business into a new market with a completely sort of new product set, but overlaying our culture of care and consideration and responsibility, we're demonstrating, to all stakeholders that can be done. And I'm really proud of that. And to your point, that's really central to what we do. And I think that's also evident in the vehicle space, where we're saying we're prudently looking at not overextending people. If a loan is secured against an asset like a car, and that car comes down in value as you would expect as things normalise, you don't want people left in a position where they're overextended. So, we're being prudent and careful as to how we're growing, and that's showing through in our credit metrics. And I think that's a really key point.
What about sort of the bad debt side of things? Because we're talking about the positivities and the growth of the loan book and things like that. What sort of percentage write-downs do you have? Because it is the loan market. People can get themselves into a bit of a mess and a muddle. Does that impact the business at all? Do you have to be a bit careful in that area?
Yeah, absolutely. I think if you're thinking about an unsecured loan that's extended to someone who hasn't got a great credit file or record, our customers are in that sort of space where the banks won't look at their position. They're too high risk. Now, we certainly don't want to be extending money to people that can't afford to repay us. It's just not good for anyone.
Yeah.
So we're trying to weave through that challenge of determining, someone with a bad credit file can be a good borrower. And we're really trying to find those people.
And so does technology allow you to make that more efficient, I guess? In other words, can you grow more quickly because of the technology that allows you to weed out who you want to do business with?
Yeah, it certainly does. And I think people would probably be surprised if they came in and saw what Cashies was processing in terms of data to arrive at that position. They'd be amazed. We run artificial intelligence across every application, looking at the profile of that person sort of back through history in our loan book and how they've performed to determine whether they're going to be a good borrower. So you absolutely need a big data warehouse. You need a great technology team. You need the latest approach in terms of particularly around credit risk, how you build your models and feed your models. And then the machine continually learning. And if you think about a COVID disruption period too, ensuring that you've got all of those things right, great human overlay and experience watching this sort of playing through. So very, very interesting.
Sam, we're through the worst, we hope, of the COVID side of things. Having weathered that storm at Cash Converters, have you got a smile on your face? Are you starting to say, look, you know what, if we can get through COVID and if we can get through, a lot of our stores being closed and still deliver a dividend, which we'll get to in a minute, to our shareholders, what do you see for 22 and beyond?
Kerry, I'm really so pumped. I think because of the work that I know that's gone into getting all of this right, and then the COVID delay just being a short-term delay, like we're still going to sort of come through this, like you say, much stronger, much different looking. And I think we'll surprise people. And the investment we've made to get there quick is really quite impressive. And what that then means is that as we grow our loan books and generate more free cash flow, which our business does really well, we're now shifting our mindset to how do we invest that free cash and the cash on our balance sheet, and how do we in a disciplined and sensible way grow this business? So that's really exciting, I think, because having a great, robust platform now and a massive customer data pool and great brand recognition, we can really start to pull the business in a different direction and meet new customers in new segments with new product.
Okay, then. New customers, new segments, new products. Come on, Sam. I want to know the new segments of the new customers and new products. Going to share?
We have released a new product. I think the challenge of just creating something simple, low cost, that is wrapped under our responsible lending regime, which we've elected to extend into all product development to future-proof our business. So we've dropped a very simple 5% repayment fee loan product. It's just a single instalment loan repaid for a 5% charge. So it's low cost and easy to understand. And it's a digital only offering. So I think as people have gotten more familiar with buy now, pay later and started using buy now, pay later, which is exempt under the Act from some of these safe measures that I'm talking about that we extend, there's a problem that's sort of started to present for consumers. And what we're trying to do is solve that problem by giving customers We're
What's the
giving
problem?
customers a simple, low-cost option to come into our business and get themselves out of the position they're in. So where there are multiple buy now, pay later transactions coming out of a bank account on a single day, causing people to overdraw and become, put in a difficult position, they need to be wrapped into an amortizing loan that repays. If you don't repay that debt, you'll never get out of that debt cycle. So we feel that if we can get more younger people into our business and offer them that repaying sort of loan option, over time, they're going to be left in a better position than just giving them more buy now, pay later loans or other loans.
Yeah, so because the buy now, pay later, they kind of think that I've got my goods, it doesn't really matter. But then all of a sudden these payments start coming out, and that's when they get into trouble. And what you're saying is there's a loan, pay off all that buy now, pay later, get that done. And it's a digital one. It's a 5% interest rate. Simplify everything.
Yeah, that's exactly right, Kerry. I think it's sort of, we know that if you've taken out debt, you've got to repay it. The younger cohort of customers, they treat it differently.
Yeah,
in many ways, they're very responsible, but the lenders that are extending this credit don't have to run these checks. So, I think if we can somehow help to bridge people out of that the exempt sort of space where those considerations aren't in place, when they come to us, we need to check what other obligations they've got. We need to give them a plan to repay their debt and leave them in a better position. And it's so important, really, to help people have a solution to the problem, not just to feed it further.
absolutely. I totally agree with you. Do you think that the growth in buy now, pay later has been enormous? Do you think that now reality is starting to hit a number of people, and so there will be a swing, in other words, a lot of growth for cash converters with this new product?
Yeah, 100%. I think we see bank statements, we see how people are behaving, and we see what other lenders and buy now, pay later providers are doing. So, through our analytics and generating product insight, we're really conscious of helping people solve this problem in the right way. And that's really spawned our Pay Advance product, which is just a simple way to get people in to then say, it's almost like a financial advisory session where each loan we're having to make sure the loan's suitable and the person can repay it. The more people we can get to help with this, I think the better.
I just love that. I love the fact that you're looking at this in a responsible way, but I would be irresponsible if I didn't talk about investors, shareholders, the opportunity for people to invest, or I shouldn't really say that, to take a look at cash converters, because you've just paid a dividend, a 1 cent fully franked dividend. Talk to me about that. You paid a dividend before. We all love a good dividend, Sam. So talk to us about the dividend and the growth you think you can see there, because that's something people always like.
Yeah, I guess ultimately the dividend is a really strong sign of confidence from our board in our underlying business operation. If you kind of think back to what we were talking about, that first half and the impacts of, 24% of store trading days lost, a lot of the network closed and things looking dark for retailers. What we've actually done is generate good free cash. We've got a really strong balance sheet. We run a good lean business, and it's put us in a position where we can support that dividend again, even through this period. So I think it's a great sign of strength and confidence in the financial result. And I'm committed to trying to continue that, subject to all going well going forward. And I just think it's a nice balance. We really do want growth. We're all about growth, but at the same time, I'm a shareholder and I appreciate a fully franked dividend on the way through.
Absolutely. Well, Sam, we're running out of time. You know what I like to do. It's an investor audience out there. So what I want to do is ask you the 3 reasons why my audience needs to sit up and take a good look at the ASX code CCV right now.
Kerry, I think it's pretty simple. You said we're trading at 26 cents or that market cap of $160 million. You look at our financials, that's low from my perspective. When we've got growing loan books, like I said, we doubled that longer term loan book and our overall loan book was up 23% across the 12 months. So good revenue profile looking forward. We've got a strong balance sheet. We're well cashed up. We're on the front foot in terms of acquisitions and opportunity and investing in our business. And yeah, I guess I'd finish with that dividend on that share price. That's a pretty good yield and it's fully franked.
I love finishing on a dividend comment, but I'll say this as well. I like the fact that you guys are cleaning up what I would see as a little bit of a murky sector. So I congratulate you on being a lot more transparent and I guess helping more people in the end. So congratulations to the growth. And we look forward to talking to you again in the next quarter. But for now, Sam, great to see you again. Thanks for joining me on Small Caps today.
Thanks, Kerry. Nice to speak to you.